In this presentation, we will discuss income recognition concepts. With regards to our income tax formula, we're going to be up top in our income line. Although when you think about these concepts, you can apply them to income and expense type of concepts. Now, when we think about the income recognition, as we talked about in prior presentations, oftentimes the recognition of the income will be driven by forms, such as a W-2 form, 1099 form. When we have those forms in pretty straightforward return, the income is what it is. What's on the tax form is basically what we're going to be putting into the tax return. However, there are times when we need to consider the income bases that we will use. So these are going to be kind of accounting terms that we're going to be talking about when we talk about the bases we're going to use or the methods that we will be using. One area this may apply is if we had business income such as a Schedule C business income. So the two types of methods we would be considering, the two different methods you usually consider with accrual accounting is a cash method and an accrual method. So a cash method is income is reported when cash is received and and expenses reported when cash is paid. So the cash method is fairly straightforward because we're going to be reporting income and expenses with regard to when cash is received and distributed. On the accrual method, income is reported in period earned and expenses reported when incurred, used, or consumed. So these are the two contrasting methods. Now, you could have some kind of mix between these two methods, and when you think about the tax code, oftentimes you may have some mix. Even when you're thinking about accounting principles, you could have a mix between these two concepts. For example, you could have a company on a cash basis, but they're not going to have their cash basis for everything. They're going to use an accrual basis for some types of concepts. The general idea here is the cash basis should be somewhat easier to be dealing with because you can tie it back to cash. So if you have a question about the transaction, you're going to be using cash as the driver. However, the cash basis can be manipulated in some way by adjusting the cash flow in a way that is different than when the actual revenue was received or expenses incurred, and that can manipulate the amount of revenue and expenses, the look of the income statement, which can have an impact on the taxes as well. So remember, when you think about these two types of methods, what you're really thinking about is timing differences. You're thinking about when is revenue recognized and when should the expenses be recognized. Under the cash method, revenue is recognized when cash is received, expenses when cash is paid. Under the accrual method, revenue is recognized when it has actually been earned, when the work has been done, and expenses when they have actually been incurred. Now, note that the accrual method is actually more accurate because you want to recognize revenue generally when you're looking at performance when you actually earned the revenue as opposed to when you received the cash. Why? Because the cash could actually be somewhat different in time as to when you earned it. And if you intentionally manipulate the cash, then it could be a lot different. For example, you could ask someone to pay you today for 5 years worth of service that you will provide at some point in the future. That in that situation, you would be recording revenue under a cash basis, even though you haven't really earned it. You got money and you haven't done anything, and you're going to be working for 5 years without getting the money. There's a big distortion there in what the cash is basically telling you and what is the reality of the situation. And you could have the opposite. You could be saying, hey, look, you pay me 5 years from now, promise to pay me 5 years from now. We'll sign a contract on it and I will do the work today. That means that you did the work today. You're not going to get paid for 5 years. You actually earned the money. It's basically yours. You just haven't got it yet. And therefore, again, you've kind of distorted things way out of distortion to what actually happened. You've done the work that the money's basically yours at that point in time. And so you can see how the cash method could kind of be distorted. Now, normally, the cash in normal kind of transactions is fairly close to when the actual recognized revenue was recognized. And the benefit of the cash method is that you can check it, of course. You can say, well, let me follow the money, and I'll be able to determine what happened. So that's why normally when you think about individual income taxes, you're thinking about a cash method because the IRS likes to be able, well, this is my perspective on it, to be able to go in and be able to check. It's easier to verify a cash method. It's an easier method to use. So typically you're going to have the IRS and then you're going to have deviations, of course, from it. Partially those deviations are going to be in order to stop people from abusing a tax method in such a way that they manipulate when cash would be received and therefore manipulate the amount of taxes that you're going to be paying. So that's going to be kind of the general rule when you're talking about normal like individual type tax reporting. So, and you could have exceptions to that when you think about the business income, Schedule C, and business type income. So the main thing to know here is that revenue is not the same thing as cash. Expenses are not the same thing as cash. You're going to use cash in a cash method to have some approximation as to when the revenue was actually incurred. So the cash is being used as basically smoke is close to the fire. If there's cash going, that's pretty close to when, if cash came in, that's pretty close to when the actual work was done. We would assume if there's cash, that's like smoke to the fire. That's like if you got money, you must have done some work, right? I'm assuming some work happened around here somewhere. There's got to be some work that happened. So, but it's not the actual fire, because the revenue, what would determine the actual revenue is when you actually did the work and have then earned the cash. If you didn't get the cash, but you have a promise to be paid the cash and it's essentially yours, then you still typically would have the revenue under an accrual method. So the cash method is basically a simplified way because it's easier to follow the smoke to the fire. It's easier to follow the cash to the actual transaction, the revenue, or the cash that left, some type of reason why the cash was paid, which would typically be an expense. So if you look at a normal type of transaction, if you got like owner A is purchasing pizza from owner B in this case, and you think about the two methods, a cash and accrual method, the transactions that would happen on owner's A side under a cash method, cash would be going up, income would be going up, right? We would be recording income. Under an accrual method, we would have the same transaction here. Why? Because this transaction, the timing, the smoke is right next to the fire, right? It's at the same point in time. So we under the cash method, we're recording the same transaction, but we're recording it because we see the smoke, right? And under the accrual method, we're reporting it because we see the actual fire, what actually happened, the transaction that took place. And on the other side of things, if we're the other owner on the cash method, cash would be going down because we're paying the cash in this case, and the expenses would be going up because we're incurring the expense. So now we're thinking about the expense side. Under the accrual method, it would be the same transaction for different reasons. The transaction under the cash method, the smoke, the cash is leaving, that's the smoke. The actual fire was the actual work, the actual benefit that was received in this case. So the benefit was received, so on an accrual method, that's going to be the driving transaction. Now, if you think about when these two things, when the smoke is not right next to the fire, for example, this time owner A is going to be providing legal services to owner B, and they're going to want a payment up front. So they're going to want a down payment for the legal services. So now owner A got money, but they haven't done anything yet. They haven't actually provided the service yet. Well, under a cash basis then, cash would go up and income would go up because the smoke, they see that they got the money. You'd have to report the cash. Under the accrual method, however, cash would go up and we wouldn't be reporting income, but a liability. Why? Because although you got cash, you didn't earn it yet. It's really a liability because you owe the legal services in the future. So that's going to be the difference. Now you have a difference because the smoke is not next to the fire. It's a timing difference. Now when we do the work, then you will be recording the cash and you'll reduce the liability and record cash. So that's the timing difference that can happen. And that timing difference can be kind of manipulated, and that's what the IRS is, going to be concerned with to some degree when you think about different types of methods. So in other words, in the long run, it should all kind of work out and be basically the same. But in the short run, there could be problems with it due to timing differences. On the other side, owner B, cash would be going down, expenses would be going up. So now we're considering the expense side of things, which would be reported because the cash left, the smoke. You saw the smoke go, but under the accrual method, cash would be going down, but we would not be recording the expense because we would basically have a prepaid asset. This person would owe. We've paid this person. They didn't give us anything yet. What do they owe us? They owe us legal services that we expect to receive in the future. When they give us those legal services, we would then, under the accrual method, reduce the prepaid assets and record the related expense. So that's a timing difference that would be there. The other side of the timing difference would look something like this. We would say owner A provides the legal services up front, but has not yet been paid, will then bill the client in the future. They're going to give the bill in the future. Therefore, all we have yet at this point in time is an IOU. What's going to happen then under a cash method, no entry. Nothing's going to happen because no cash happened. Although something did happen in terms of legal services being provided and cash being owed. Therefore, under an accrual method, we're going to have accounts receivable, an asset going up. In other words, we've earned the money, right? The money is basically ours. We have, it's our money at that point in time. We just haven't yet received it because the work had been done. And then the income would be going up under an accrual method. And you can see how this can kind of be manipulated, right? What if this person for taxes said, I'm going to pay you today, and you say, no, could you just pay me in January of next year? Because if you pay me today, I'm going to have to record it for my taxes, and I'd rather record it next year for taxes. So how about you pay me in January? And they just hold on to the money. Well, in essence, in that case, this person has, for all practical purposes, basically the money is theirs. They're just basically having someone else hold on to that for them. And that's going to be a situation that the IRS would be concerned about, because you can manipulate, your tax obligation with this kind of timing difference, right? And that's just the timing difference between the methods that could be used. Cash method over here, no entry. Under the accrual method, you'd have the accounts payable going up, and then you have the expenses. So under the accrual method, you'd be recording the fact that, yeah, you got paid and you owe money. Therefore, your AP would be going up, and then you would be recording the related expense would be going up under the accrual method, because although you haven't paid it, you have incurred it and do owe it. So those are some general rules. Again, that often applies when you have the business concept and you're talking about Schedule C types of business, cash versus accruals. A couple of the concepts. Constructively received income. You can find more information about this in publication 525. We will include that for you. You are generally taxed on income that is available to you, regardless of whether it is actually in your possession. So if it's available to you, then it's typically going to be income, whether or not you have it in your possession. Again, you can think about situations where people try to say, I'm not going to open this check that I got in the mail till later. Well, it's pretty much yours, it's there. If you leave it in the mailbox, that's not gonna, the IRS isn't gonna be convinced by that typically. So a valid check that you receive or that was made available to you before the end of the tax year is considered income constructively received in that year, even if you don't cash the check or deposit it to your account until the next year. So basically, if you just hold on to the check and say, well, I'm just not going to deposit it till the next year, that the IRS doesn't see that as valid, right? So you got the check, it's constructively yours at that point. For example, if the Postal Service tries to deliver a check to you on the last day of the tax year, but you aren't at home to receive it, you must include the amount in your income for that tax year. If the check was mailed so that it couldn't possibly reach you until after the end of the tax year, and you otherwise couldn't get the funds before the end of the year, you include the amount in your income tax next year. And again, that would be applying on the different method, depending on the method of cash and accrual type method you're being using. So we have the prepaid income. This is in publication 525. In most cases, prepaid income, such as compensation for future services, is included in your income in the year you receive it. So typically, prepaid income, you'll remember, if you were on an accrual basis, you wouldn't be reporting prepaid. You got money, but you didn't do any work yet. But on a cash method, the IRS, which you're talking like your individual income tax, typically is more on a cash. If you got the income before, then you would typically have to report it, even though you hadn't yet done the work yet. However, if you use an accrual method of accounting, you can defer prepaid income you receive for services to be performed before the end of the next tax year. In this case, you include the payment in your income as you earn it by performing the service. So that's basically an explanation of the accrual versus the cash method. And you can think about some other kind of situations where this might be the case, especially on the deduction side, even on the individual type of taxes. If you're considering whether or not you should be paying more expenses, something like if you're able to deduct, for example, property taxes of some kind, then you might consider, can I pay the property taxes before the end of the year? Well, if you're on a cash method, to some extent, within limitations or whatever the law is related to whatever expense you're thinking about, you may be able to pay to some degree more of your expenses, and hopefully then get more of a deduction in some cases.